All right, welcome guys to our beginners video training on Forex, the overview. Yeah, so I think we should begin now. So basically, when we trade, we are basically trying to make profit from following um, differences in price and changes in price between currencies. As you can see on my screen, we currently have GBP CHF, which is a Great Britain pounds, and Swiss franc. So what we are trying to do, the purpose of every trader is anytime you hit the sell button, you're believing or you're expecting that the market, for instance, you want to sell GBP CHF, you're actually selling GBP and buying CHF. So it's always in a pair. So what you're trying to do, you're trying to move down a couple of pips to your target area. So that is what we mean by selling. Then when you're buying, you're trying to move up a couple of pips. Let's say, for instance, I'm currently at this price level, which is 1.1409, and I hit my buy button. I'm expecting that, okay, this price will change from this 1.409 upwards. You understand? So that's the buy. So let's say I was here before, which is 1.220, and I hit the sell button. So you see that the market or the price has moved from 1.22 and dropped to about 1.140, which is somewhere here. So you see that you have actually sold the market. Now, as a trader, you're looking at different confluences, different things that will make you think that, okay, this market is about to sell or this market is about to buy. Over the course of this series of our beginner videos, we'll get to the point where we will be showing you different reasons why you should hit the buy or hit the sell button based on your analysis of the current market conditions. Do you understand? So we'll be keeping this video very simple, very short. This particular video will just seek to show you the basics of the general overview of the market here. So yeah, so this is the interface of the trading view, which is where we actually um, analyze our market from. As you can see, for instance, I might want to draw a trend line. How will I put this trend line now? Let's say this is a trend line. Yeah. So I might say, okay, I'm trying to analyze this market according to the position of this trend line and all that and what have you. So basically, we are looking at the analysis here, and then we are making our entries on trading view on MT for MetaTrader. Sorry, our entries will be on MetaTrader. So that is basically how we trade and how we approach the market. So this is actually a monthly time frame, so which is a lot of pips, a lot of movement here. So we'll be moving to bullish and when you say market is bullish or when you say candle is bearish and all that. So now basically if these are candles, unfortunately, okay, let me see if I can, let me just move my let me go to let me go to trading view without my account so that you can see what the typical charts will look like for people that have not really set up their charts to look like the way I've made mine to look. So basically we are looking for, let's say for instance I go to gold. Yeah, I can see that I'm not logged in, so it should, yeah, it should be red. It should be red and green instead of all black. So you see, basically, this is how the charts will look when you initially start. When you log into Trading View, the charts are usually unmarked. There's basically no analysis done. So you just see a bunch of candles moving. So these individual rectangles you see here, they are known as the candlestick. So it is assumed that when the candlestick closes as green, as you can see, this is a full month. So in this month, price moved from 1635 to 1766 before it closed. So it means that price started at a lower price and ended at a higher price. So that's a bullish candle, or a candle that's yeah, a bullish candle. So for a bearish candle, let's take this candle for instance. So you see that the market opened at 1906 at the start of the month and ended and closed at 1770, which is 1770 at the end of the month. So this is a bearish candle. I'm talking of this candlestick here. So that's a bearish and a bullish candle. Now these are the wicks. A wick is actually where the market got to before coming back. So basically the wick represents the extremities of the market, where the market moved to and how it came back. So let's say for instance this market actually opened here now 1893, and then it moved all the way to 2077, which is 2077, and then it now came back to 1936, which was where it closed. I'm talking of this particular candle. This they call this one a shooting star. So basically, this is the movement. So as a trader, like I rightly pointed out, we are trying to follow this movement down or follow this movement up. And how we measure the extent of this movement down and up is known as the pips, which is calculated from this right hand side. As you can see, this is currently gold. So 1921 is where the price currently is. So let's say for instance I enter a sell at this 1921. If the market moves from this 1921 to let's say 1600, it has moved um that's like thousands of pay because this is gold. It has you cannot measure what you've gotten by doing 1921 minus 1600, which is about 3,000 pips or more, if I'm not mistaken, or more than 3,000 pips. So this is how we move. Okay, let me switch the trade to a familiar pair so I can give you an exact calculation. Sorry, let me remove gold. Okay, let's say we're on a Euro USD chart. So let's say for instance when this market was here, which is let's start from 1.0. Let's say you started buying from 1.0. If this market moved from this 1.00 to where you are now, the market has currently moved 867 pips. 867 pips is about is 867 pips. But now, depending on your position size, there are different kind of sizes that you use in entering the market. You could enter with 0.01 lot size, 0.02, 0.5, depending on your account size. So when you calculate your lot size multiplied by the number of pips, that is what translates to money. Let's say for instance I had entered this market on a 0.01. So that means for every pip we have 10 cents. So times 800, that would be, that means for if you move 100 pips, that means I've made $10. So $80, you would have made $80 if you entered from 0 point, let's say you enter from 1.00 and you move to this place at 800 pips. So if you were on 0.01, which is the smallest lot size, you'd have made $80 with this move. But keep in mind that this is a monthly move. So again, my style of training people is to be conservative. You're not coming to forex market to make all the money in the world. You're coming as a responsible trader that is trying to follow the rules and not break any rules. So yeah. So you see that this is like 800 pips. Now, the next concept that I'll be talking about, this is the trading view interface, and I've talked about pips, I've talked about movement. But if you want to learn in details how to calculate pips and everything, all these things I just stated, you can go on this website, babypips.com. Yeah, on babypips.com, you get the fundamentals of forex. They'll train you, they'll teach you how, they'll train you what a candlestick is and all that you need to know about the forex market concerning the fundamentals. Because most times when we start training people like this, we are training you as Oh, why is this thing showing? I don't want to join. What am I joining? Oh, now they made me join something. So sorry. I don't want to join whatever they're asking me to join. So you can see that for whatever we are doing, let me go back to a particular pair so that it makes more sense. So let me just turn GBP. So we are basically trying to follow the movement of the market. If you're hitting sells here, as the market keeps going in your direction, you're making money. If you're hitting buys, as the market keeps going in your direction, you're making money. So that's just basically what it is. Keep in mind that if you're saying this market is going to sell, let's say for instance, you are seeing this bearish candle here because it started and at a high value and closed at a lower value, and you now hit a sell here. Now this market has reversed on you and you see that you start losing money. So forex is both ways. If you're saying it will go down, if you're going for a sell and it doesn't go down as a sell, that means you're already losing money because it's going in the opposite direction. But if you say for instance I'm going for a buy, let's say here you're trying to buy because of you've seen this movement upwards and you're trying to buy, you find out that this buy that you're trying to buy now is actually not in the right direction. So you see that you're already losing by the market going against your prediction. So this is where the concept of stop losses will help you. So for instance, you're saying, okay, I want to buy this market, and if the market goes below this level, something should remove my position and say, okay, I'm no longer interested in buying this market again because it has gone against my prediction. So this is where you now have a stop loss that stops you from it actually closes your position in case you're wrong in the market. So stop losses, we'll get to that very soon. So the next concept, okay, no, I think this is like the overview of the trading view and the introduction to forex. So I think I'll stop here. Over the next video, we'll be looking at general market structure analysis, top down analysis, and how to get into profitable positions in the market. So this video has lasted 12 minutes. I really don't want it to be too long. So in our next video, we're looking at price action and how to analyze the market. Thank you.